Welcome to Durga Analytics. This is full domain training in banking and financial services. Before we dive into the system, data models, product or regulations, we need to start with something far more important, that is context. And this is chapter 1, Introduction to Banking and Financial Services, and it sits inside module 1, Banking Architecture and Core System, under track 1, Retail and Corporate Banking. Why does this chapter matter? Because banking is one of the most misunderstood industries in the world, right? Most people interact with banks only through mobile apps, debit card, loan or payments. But behind every simple transaction lies a deeply complex ecosystem of business models, risk controls, regulations, data flows and enterprise grade technology platforms. So in this chapter we'll zoom out before we zoom in, right? So we'll answer foundational questions like what is banking really supposed to do for an economy? How are retail banks different from corporate banks, not just in customers but in system and scale? Why do banks need more? Why do banks need core banking system, payment hubs, risk engine, and data warehouses? And how do businesses, operations, and technology come together as one integrated architecture? So this chapter is especially critical if you are a software engineer or data engineer working in banking and financial services, a business analyst or product owner translating requirements, a consultant or architect designing solutions for banking and financial services, or someone transitioning into banking from another industries. So by the end of this chapter, you will not just know banking concepts, you'll all start thinking like a bank, right? So you'll understand how banks see customers, money, risk, and data, right? Which is the foundation of everything that follows in the program, right? So think of chapter 1 as the operating manual for the rest of the course, right? So let's begin the journey by first understanding banking as the economic engine of the modern world, right? Okay, let's move to slide 2. So in the slide 2, we'll talk about the economic engine. There is banking's 3 core functions, right? So before we talk about products, apps or systems, we need to understand why banks exist at all, right? At its core, banking acts as a circulatory system of the economy, right? Just like blood carries oxygen to different parts of the body, banks move money, risk and trust across individuals, right? Businesses and governments, right? This happens through 3 fundamental economic functions, right? You can see intermediation, right? So intermediation is connecting savers to borrowers, right? Which is called capital allocation, right? The first and most fundamental role of bank is intermediation, right? So in any economy, some participants has surplus money. Those are called savers, right? You save money, and other need capital, which is called borrowers, right? So bank sits in the middle, right? You can see in the image, right? In the left side you have savers, in the right side you have borrowers. So borrowers has deficit and savers has surplus, right? So they collect deposit from savers and channel that money to borrowers in the form of loans. So this process is called capital allocations. So on one side you have individuals or institutions earning interest on deposits. On the other side, borrowers gain access to capitals for homes, education, businesses or infrastructures. So without banks, this matching would be insufficient, right? Or inefficient, risky and unscalable, right? From a system perspective, this single function drives core banking system, deposit and loan ledgers, interest calculation engines, credit scoring and underwriting platforms. So intermediation is where the balance sheets are born, right? Because somebody is putting money and somebody is getting money through the bank. The second thing is payment facilitation, facilitation, right? Which is enabling money movement, right? The second function, right? So the modern economies depend on the fast, secure and reliable movement of money, like locally and globally. So what does bank do? So bank enable card payments, account to account transfer, UPI, ACH, wire transfer, right? Corporate bulk payments and payroll, right? Cross-border settlements, right? These functions provide liquidity, right? The ability to move money when and where it is needed. So behind a simple payment successful message, there is a lot of payment hubs, clearing and settlement systems, messaging standards like ISO 222, reconciliation and exceptional handling, right? So payments are high volume, low margin, but they are mission critical, right? So if payments fail, the economy slows down, right? This is why payment systems are some of the most engineered and regulated platforms in banking, right? So this is second pillar, right? So third pillar is risk management, right? What does it do? The third core function is risk management. So every financial activity involves risk, right? So the risk can be many types. We can have credit risk, like if the borrower will repay or not, right? For example, if you have taken money and you will not pay, right? So that is credit risk. And the market risk is, will price or rate move, right? Because you see every day the market goes up, sometimes it goes down, right? Yesterday it was down, but today it was up, right? So that is market risk, right? The third type of risk is operational risk, right? Will system or process fail, right? So let's say everything is in the place, but the system is not working, right? So that is operational risk, right? Then there is compliance risk, right? So there are multiple regulations you have to follow if you are a bank, right? And if you're not following that, you will be fined, or you will have some charges on you that you have to pay, right? That is compliance risk. So you have to follow all those compliance, right? So bank don't eliminate risk, they measure, price, distribute and manage it. So that is risk management. So this includes insurance and guarantees, hedging through derivatives, right? Portfolio diversification, capital buffers and stress testing. From a technology standpoint, this drives risk engine, AML and fraud systems, regulatory reporting platforms, data warehouse and analytic layers. So risk management is what gives banks stability and protects the wider economy from shocks, right? Uh, right. So let's bring all these three pillars together. Every banking product, every system, every data model, and every regulation ultimately support one or more of these three functions, right? Intermediation, payment facilitation, risk management. So if you understand these three pillars, you can understand any bank anywhere in the world, right? So in the next slide, we'll zoom out further and look at the financial ecosystem and where different types of banks fit into this picture, right? Let's move to slide 3. Okay, so now let's talk about the financial service ecosystem. So the financial service ecosystem. So you can see the image in this slide, right? So now we understand what banking does. The next question is who does it, right? So we already understood what. Now next step is understanding who does it, right? So the financial service industry is not a single monolithic entity, right? It is a crowded ecosystem made up of multiple specialized institutions, each with distinct role, license, risk profile, and technology stack. So at the center of the ecosystem sits the universal bank, right? So let's unpack this structure step by step. So the universal bank is the hub of the system. You can see in the image, right? So universal bank is a financial institution that offers multiple banking services under one umbrella, right? So it typically provides retail banking. You can see in the left. Then there is a corporate banking. Then there is a payments. Then lending, right? Then we have treasury services, right? Then we have risk and compliance functions, right? So because of this breadth, universal banks operate the largest and most complex IT architecture in the industry, right? So they act as a liquidity provider, payment intermediaries, risk managers, and data aggregators. So most global systemically important banks fall into this category, right? So let's start with the central banks. So central banks, the regulators and the issuers, like for example, we have RBI in India, or in United States we have Federal Reserve, right? Or in UK we have Bank of England, right? So at the top of the ecosystems are central bank. So central bank do not serve customers like commercial banks, right? Instead, they act as a monetary authority for a country or region, right? So their responsibilities include regulating money supply, setting interest rate, maintaining financial stability, and acting as the lender of the last resort, right? So from a system perspective, central bank influence liquidity frameworks, settlement rails, and regulatory reporting standards, right? So commercial banks must align their system and control to central banks rules at all times, right? Okay, so that's central banks. So next is retail banks. So we talked about central bank that regulate money supply like Federal Reserve or ECB or Reserve Bank of India, right? Second is retail bank. So what does retail bank do? Right, so examples are like Wells Fargo, HSBC, or HDFC, ICICI Bank, or JPMorgan Chase, right? So retail banks focus on individual consumers and small businesses, right? So their priorities are high transactional volumes, right? Standardized projects like, for example, home loan, or maybe deposit, FT, recurring deposits, all those are standardized products, right? Then they have strong digital channels, right? They also focus on cost efficiency and automation. So retail banking drives massive scale in core banking system, payment platforms, customer onboarding like KYC and all, and fraud and anti-money laundering systems. So even a small improvement in efficiency here can impact millions of customers because they serve multiple customers, like millions of customers, right? Now we have corporate banks in the right side, right? So corporate banks, right, serve medium, large enterprises. For example, JPMorgan Chase, BNB Paribas, right? So their primary purpose is powering enterprise and governance, right? So corporate banks serves medium and large enterprises, multinational corporations, government and institutions. Unlike retail, corporate banking deals with fewer clients, extremely high value transactions, right? So instead of thousands, right? So they deal in like millions, right? So they deal with extremely high value transactions, right? So they have customized solutions for particular institutions or governance, right? They work on relationship driven models, right? They don't work like traditional retail banking where you very generic and one to many relation, right? They are more in one to one, or you can say more relationship driven models, right? So that's where trade finance, treasury, liquidity management, structured lending becomes central, right? So in corporate banking, systems that we build as a IT professional, right, must support complex workflows, limits, and approval, often across multiple countries and currencies, right? So that's corporate banks. Then we have investment banks in the right side. Investment banks focus on capital raising and market activities, right? So their service includes merger and acquisitions, right? For example, Goldman Sachs, right, is a investment bank. Merger and acquisition, equity and debt issuance, right? trading and market making, structured products, right? Which is combination of multiple asset classes or multiple multiple instruments, right? It can be, right? So technology investment banking is heavily focused on low latency trading system because they involve more in risk management, and 1 second or 1 millisecond can be huge loss at times, right? And they focus on risk and valuation engine, right? Market data platforms, right? So these segments operate at high risk and high reward, right? So this is investment banks at high level. Then we have fintechs and neobanks, right? So fintechs and neobanks are like digital disruptors, you can call them, right? So for example, Monjo or Revolut, right? Fintechs are like neobanks specialized in exercise, experience, speed, and innovations, right? So they often focus on single product or workflow, right? For example, they use API first and cloud native architectures, right? And they partner with traditional bank for licenses and settlement. So while they may look small, fintechs often drive industry-wide change, right? Focusing large banks to modernize legacy systems, right? So that is fintechs and neobanks. So they are mostly 100% digital, right? So that is fintechs and neobanks, the digital disruptors we call them. Then at the bottom you see NBFC. So NBFCs are like credit without full banking license, right? For example, lending club, right? So for example, you start a non-banking financial company focusing mainly on lending and credit products, right? For example, they operate with fewer regulatory permissions. They don't have full banking license, narrower product scope, so they have limited number of products, higher risk tolerance, right? So they can like they can tolerate a lot of losses compared to the traditional banks because and NBFC are especially important in emerging markets, right? For example, India and Brazil, something like, right? SME and consumer lending, they are involved in the SME and consumer lending, and they are more in focus towards financial inclusion for the lower class or lower middle class or something like that. So that is NBFC, right? So the key takeaway from this slide is, the big idea here is the financial services system is not flat, right? It is layered and interconnected, right? So universal banks sit at the center, specialized players orbit around them, money, risk, data, and regulation flow between all participants, right? So as a professional in banking or technology, your role will always sit somewhere inside the ecosystem, right? In the next slide, we'll make this even more concrete by comparing retail and corporate banking and understand why they are fundamentally different businesses, right? So let's move to slide 4. So let's talk about retail versus corporate banking. That's a great divide, right? So up to now we have spoken about banking as a single industry, right? But in reality, banking is split into two fundamentally different operating models, right? So this slide captures what we call the great divide, right? So retail banking is on one side and the corporate banking on the other, right? So let's understand the difference clearly because it influences everything, right? Products, it influences everything: products, systems, data models, risk, and even carriers, right? So retail banking is business to consumer, what we call this B2C. So retail banking focus on individuals and households. So this includes saving and current accounts, debit and credit cards, personal loans, auto loans, and home loans, and digital payments and wallets for sure. So defining characteristic of a retail bank is scale, right? So retail bank process millions of customers, millions to billions of transactions, small value amounts per transaction, right? So the value of transaction is small, right? But the number of transaction is millions to billions, right? And the customers are millions of customers. So because of this, retail bank is highly standardized, strongly automated, because they are handling millions of customers, millions to billions of transactions, strongly automated. And they are optimized for speed and cost efficiency, right? From a technology perspective, retail banking systems are designed for high throughput, right? Real-time processing, straight through processing with minimal human intervention, what we call is STP. So think of retail banking as an industry scale operation, right? Compared to that, we have corporate banking, which is business to business or B2B, right? So corporate banking serves businesses, large enterprises, multinational corporations, governments and institutions. So the defining characteristic is value, not volume, right? So the corporate banking deals with fewer clients, far fewer transactions, extremely high transaction values, often in millions, right? So corporate banking products are customized, they are not very standards, and they are relationship driven, like we talked earlier, right? And they are structured around client specific need, right? They are not very generic, right? And the technology is important here because the technology here must support complex approval workflows, right? Because so this is customized, there must be approval at each step. It's not generic. In generic, there is a straight through processing because it's very generic, right? And very standardized, right? You can follow the same pattern, right? But here, since this is customized and more structured around client specific needs, there is complex approval workflows, right? Credit limits and exposure management is important here because the other party can default because they are mostly institutions, right? And there is huge size deal, right? So if you lose one client, if your one client defaults, right, the bank can go bankrupt, right? Something like that, right? Sometimes it happens, right? So, and the corporate banks also support multi-currency or multi-country operations. For example, JPMorgan Chase, right, might be operating with multiple countries, right? So human decision making plays a much larger role compared to retail because they are completely customized, relationship driven, and structured around client specific need, right? The difference between these two banks are important also as high volume versus high value, right? So the vertical scales on this slide shows the real contrast, right? You can see that. So retail banking sits at the high volume, right? Low value, right? So for example, there is billions of transaction, but every transaction is in thousand, right? $1,000 or in 1,000 rupees in India, right? But a corporate banking sits on low volume, so maybe around 10 transactions, but every transaction is maybe 1 billion value, right? $1 billion, right? So that's the major difference in volume and value, right? So the single distinction explains why retail system focus on performance and automation because they are very standard, but corporate system focus on flexibility and control because they are more customized and relationship driven and structured around client specific need, right? The other differences is in operation and architecture implementation, right? So because of these differences, retail banking prioritize core banking platforms, payment hubs and digital channels, right? Right. Because of these differences, retail banking prioritize core banking platform, payment hubs and digital channels, right? Because number is important here and automation is important here because of STP and standardized products. But corporate banking prioritize trade finance system, treasury platform and relationship management tools, right? Because they are more relationship driven, right? So data will also, even data will behave differently as well, right? Because retail data is massive and event driven, right? But the corporate data is structured around exposure, limit and contracts, right? So what we learned in the previous section is important for data, right? So corporate data is structured around exposure, limits, and contracts. So data will be different, right? Data handling would be different. So, and retail data is massive and event driven. So it's more automated and end-to-end automation, right? More like you can handle more data automatically. So that is more important in retail banking. If you are building a retail banking application, that is more important. But if you are building a corporate banking application, you have to manage exposure, limits, and contracts more accurately, right, compared to retail. So this divide matters because if you don't understand this divide, you will design the wrong system, right? So you'll ask the wrong business question, you will misinterpret data or apply the wrong performance expectations. But once you do understand it, banking architecture suddenly start making sense, right? So in the next slide, we'll go deeper into retail banking, right? And see how it becomes a game of volume and convenience, right? So let's move to slide 5. So slide 5 is more detail about retail banking, right? The volume and convenience game, right? A game of volume and convenience, I would say. Now let's zoom into retail banking, right? So retail banking is the part of financial system that most people interact with every single day. So often without realizing the complexity behind it, right? So at its heart, retail banking is a volume-driven business, right? So the goal is simple: serve millions of customers, process billions of transactions with near zero downtime, right? So that is retail banking in nutshell, right? That is the goal. So let's break this down, right? So retail banking customers serves individuals, families, small proprietors, or micro or small businesses. So each customer may look simple on their own, right? But at scale, even a small inefficiencies multiply into massive operational cost, right? For example, a addition of extra zero can be millions of or billions of loss because the volume is huge. So that's why retail banking is obsessed with automation to save incorrectness or errors. So the retail banking is obsessed with automation, standardization, and self-service channel, right? Because that removes the scope for errors, right? So the core banking products that retail banking serves is the most common retail products include saving and current accounts, right? Debit and credit cards that we talked earlier, personal, auto, and home loans that we generally take, digital payments, and wallets, right? So these products are highly standardized, rule driven, designed for mass adoption, right? So from a system point of view, these are template based product, right? So you create a product and you sell to millions of customers, right? So that's what happened, right? So for example, there is a home loan they have, right? And the interest rate is fixed, right? Or maybe linked with the repo rate or central bank rates, right? Whatever country you live in, right? And they sell to everybody who apply for it, right? So from a system point of view, these are template based products and the same logic applied millions of times, right? And if you talk about channels, right, where customer experience the banks, retail banking lives and dies by its channels, right? These include mobile banking apps, internet banking portals, ATMs, branch systems, or call center. Today the mobile app is the primary branch because most of the thing can be done using the mobile app, right? Every click, swipe, and tap generates data, right? That must be captured in real time, validated, authorized, and logged for audit and compliance, right? So the channel reliability directly impact customer trust, right? So if something breaks, the customer say this bank is not good, let's move to another bank, right? So it's not relationship driven, right? It's more driven by performance or benefit, right? So the technology backbone of retail banking behind the scenes, it runs on core banking system for account and balances, the primary thing, then payment hub for transfer and settlement, and then card management systems, right? Loan origination and servicing platforms. So these systems are designed for high availability, real-time processing or horizontal scalability, right? Because we are serving millions or billions of customers, so horizontal scalability is important, right? And the volume is huge. So the few seconds of downtime can impact millions of customers simultaneously, right? And that will create a bad image, right? So, so technology is very important in retail banking, right? The other thing is risk, fraud, and compliance at scale, right? So retail banking is a prime target of fraud, identity theft, or transaction manipulation. That's why retail banks deploy real-time fraud detection engines, right? Anti-money laundering monitoring systems, KYC and onboarding platforms, right? Risk system must operate at machine speed, often making decisions in milliseconds, right? So the retail banking equation is simple. Mass customers plus standard products plus digital channels equal to high volume plus thin margin plus extreme reliability requirements, right? So retail banking is not about individual brilliance. It's about industry grade execution. So in the next slide, we'll contrast this by diving into corporate banking, where banking becomes a game of relation, structure, and control. So let's move to slide 6. So in the slide 6, we are talking about corporate banking, right? The complexity and liquidity game here. So the corporate banking is a game of relationship and risk, right? So now let's turn to the other side of banking world, right? Corporate banking, different from retail banking. So if retail banking is about volume, corporate banking is about value, trust, and long-term relationships. So here the bank is not just a service provider, it is a financial partner to the business, right? So who are corporate banking customers, right? So the corporate banking serves medium and large enterprises, multinational corporations, public sector organizations, government bodies and institutions. So each corporate client represents large balance, high credit exposure, complex financial needs. So losing or mismanaging even one client can have a material impact on the bank's balance sheet, right? So the core corporate banking products are far more complex and customized than retail banking. So the products are like working capital and term loans, for example, right? Cash management and liquidity solution, right? Trade finance, letter of credit guarantees. We learned this on upcoming chapters, right? So this is just the 101 of this course, right? So we are talking about high level. So trade finance, letter of credits, guarantees, foreign exchange and hedging products, corporate deposits and treasury services. Unlike retail banking, these are negotiated, not fixed, right? Structured around contracts, often unique for client, right? And their model is more relationship driven, right? So corporate banking runs on relationship managers. So these individuals understand the client business model, structure deals and credit facilities, and coordinate across risk, legal and operation teams. So technology supports the relationship, but human judgments so technology supports the relationship, but human judgment remains central, right? The other thing is credit risk and exposure management, right? So risk is core concern in corporate banking, right? Risk is more concerned in corporate banking that bank must continuously track credit limits, outstanding exposure, collateral and guarantees, country and counterparty risk that we talked earlier. This requires sophisticated credit system, right? So you need to build the credit system that will check before you can do the trade, right? Real-time exposure calculation, right? So exposure can go up and down based on the market risk, right? So you have to calculate the real-time exposure in real time. Stress testing and scenario analysis. So a single mispriced deal can create multi-year losses, right? So technology landscape in corporate banking are designed for flexibility over speed, right? Control over automation, auditability over volume. So key platform include like loan services system, trade finance platform, treasury and liquidity management system, limit and collateral management engines. Every transaction passes through multiple approval and controls, right? So the corporate banking equation is few clients, high transaction volume, value plus custom structures equal to relationship focus plus risk intensity plus strong governance. This is where banking feels closest to finance, law and strategy combined, right? So in the next slide, we look on how the banking value chain structure work, right? Okay, let's move to slide 7 then. So let's talk about banking value chain structure, right? So up to this point we have talked about what banks do and what do they serve, right? Now it's time to understand how banks actually operate internally, right? So regardless of whether a bank is retail or corporate, small or global, every bank follows a common operational structure. So that is known as banking value chain. So the value chain is logically divided into 3 major layers, right? First is front office, next is middle office, and then there is back office. So think of this as an assembly line of banking operation, moving from customer to final settlement, right? So front office is customer and back office is final settlement, right? So let's talk each layer one by one. So front office is client facing layer, right? So the front office is where the bank meets the customer, right? So this layer includes digital channels like mobile and internet banking, right? Branch system, relationship managers, sales teams, customer onboarding and account opening, right? So the front office is responsible for acquiring customers, capturing transactions, initiating requests, right? So from a system perspective, this layer is optimized for user experience, speed and availability, right? However, the front office doesn't make final decision. It only initiates them, right? So as you can see in the slides, right? Front office is client facing, channel sales and onboarding in nutshell, right? So we understood that. Now in the second part, we have middle office, which is risk and control, right? So credit risk, compliance and limit at very high level, right? Let's understand it deeply. So middle office is a risk and control layer. You can say that. So the middle office is the brain of the bank. So this layer focus on credit risk assessment, right? Compliance and regulatory checks, right? Exposure and limit management, fraud and AML controls, right? So every transaction initiated in the front office must pass through the middle office, right? So you start a client onboarding, for example, and you start a transaction, right? So every transaction initiated in the front office must pass through the middle office for validation, risk evaluation and policy enforcement, right? This is where the credit limits are checked, right? Transactions are flagged or approved, right? Regulatory rules are applied, right? So middle office system exists to protect the bank, right? Even if it slows things down slightly, right? Doesn't matter. So it must do all these validation or evaluation or policy enforcement, right? That is the purpose of middle office, right? So you can see in the slide, credit risk, compliance and limits. These are mainly high level words. Then we have back office. So back office is settlement and accounting layer, right? So the back office is where money actually moves and records are finalized, right? So this layer handles clearing and settlement, reconciliation between systems, accounting and general ledger posting, financial and regulatory reporting, right? So back office system prioritize accuracy, auditability and consistency. So errors here don't just cause inconvenience. They can result in financial losses regulatory penalties or legal action, right? So this separation exists. The reason is it exists to prevent fraud and conflict of interest, right? So enforce checks and balances, meet regulatory expectations, and scale operations safely, right? So in fact, regulators explicitly expect banks to maintain clear separations of duties across these layers, right? So that is also one of the regulatory requirements. But the separation is not accidental, and that we already talked about why it exists. It's not accidental. It's driven by rules, right? Then there is common patterns across all these three layers, right? So at the bottom of the slide, you will notice shared infrastructure that cuts across all offices, right? So that is customer 360 view, which is a unified customer data model, right? So all the customers should be available in that customer 360 view, right? And the modular architecture, right? So the API and service connecting systems is important. That it involves all these three layers and their data warehouses, analytics, reporting, and regulatory submissions. So these shared layers ensure that data remain consistent, right? System remain loosely coupled, right? The bank can scale and modernize over time, right? So yeah, so that is the primary purpose of this common pattern across all these three layers, right? So from this slide, the key insight is a banking transaction is never a single system event. It's a controlled journey across front, middle, and back office system. So if you understand this value chain, you can design better banking system, right? And debug issues faster, communicate effectively with business and risk team, right? So that was the purpose of this slide, right? In the next slide, we'll map this value chain to real retail banking operational journey, step by step. Okay, let's move to slide 8. So slide 8 is mapping the retail operational journey, right? So in the retail bank, how the operation happens end to end. So that's the purpose of this slide. So the focus is speed, automation, and self-service. That is the primary retail that we talked earlier, right? So now that we understand that banking value chain in the previous slide, let's bring it to life by mapping a real retail banking journey from start to finish, right? So this slide shows how a single retail customer interaction travel across systems from onboarding to all the way to compliance and reporting, right? So retail banking is designed around speed, automation, and self-service that we talked. And the journey reflects exactly that. So let's walk through step by step. So the step 1 you can see in the slide is acquisition, right? So the customer acquisition, right? So journey begins with customer acquisition, right? This typically happens through digital onboarding portals, right? Like or mobile apps or branch assisted onboarding. Either you go to the branch or you go to the mobile app or you open the website and you start onboarding, right? So at this stage, the customer provides identity details, your name, address, phone number, identity details, address and demographic data, right? KYC documents like ID card or whatever, the passport, right? For example, or a permanent account number card, right? Or SSN number, right? These are the KYC documents you pass. System involved here include like CRM platform, that is customer relationship management, and digital onboarding solutions, right? Right. That can be a customized solution built by bank or maybe a generic one. And then there is identity verification service, right? So if you do the KYC, the identity verification service automatically does that. So the goal is simple here: onboard the customer quickly, securely, and compliantly, right? So we should follow all the compliance measures. The second step is account setup. The account setup is once the customer is approved, right? And you get the KYC documents and you get the demographic details, identity details. The next step is account setup, right? So this is handled by core banking system, right? So for example, Wells Fargo core banking system, right? So Here the bank create the customer profile, generate account numbers, link products like saving or current accounts depending on which one you are trying to open. This step stabilize the system of record or SOR for the customer money, right? From this point onwards, all the balances, transaction and limits trace back to the core banking system. So this is step 2, account setup. Step 3 is transaction processing. So now the customer start using the account. So this include payments, transfer, card transactions, UPI or real-time payments, right? So these transactions flow through core banking system, payment hub, real-time processing engines, right? So retail system are optimized for high throughput, low latency that we already talked, right? Straight through processing, right? So decisions here are made in milliseconds, not minutes. So that is step 3. Step 4 is credit origination. So when the customer applies for a loan, the journey enters credit originations. So this involves loan origination system. So that is a separate application. Then there is an application called credit scoring engine, right? And so credit scoring engine will identify your credit score. For example, CIBIL is one of the credit scoring engine. There can be other credit scoring engine as well, right? And then there is a rule-based decisioning. For example, the CIBIL score is less than this. You are not allowed to reimburse the loan, or your loan will not be approved, right? So something like that. So there is 3 systems: loan origination system, credit scoring engine, and rule-based decisioning, right? So in any modern banks, this step is fully automated, data-driven, completed in minutes, right? So this system evaluates income, credit history, risk profile, and it either approves, rejects, or accelerates the application, right? So this is credit origination. Step 4. Step 5 is servicing and engagement, right? So once account and loans are active, the focus shifts to servicing. Now, in the previous step, you already got the product, right? So maybe you applied for a loan, so your loans are active. So now the focus is shifting to servicing, right? So this includes balance inquiries, alerts, notification, statement generation, customer support interaction, right? And the middleware and channel systems, right, plays a key role here, right? So it ensures like consistent experience across devices, right? For example, if you are accessing on the mobile application, the experience is consistent compared to what you see on the website. It should not be completely different experience, right? So real-time updates should be on every system. It should be consistent across system, and it should be updated real time. For example, if you are doing a prepayment, or maybe closing a loan account, it should be updated automatically in real time. High availability, right? It should be always available, right? It's not like, right, it's not available right now, it will be available after 30 minutes, and you cannot do your transaction or right now, or you cannot see your balance right now. This is where customer satisfaction is on or lost, right? So if something is down, right, for 30 minutes, you lose that customer, right? And step 6, which is the last one, is compliance and reporting. So every step in the journey generates data, right? So data flows into compliance system, AML monitoring platforms, general ledger and reporting system. So this ensures regulatory compliance, audit readiness, financial transparency. And importantly, compliance is not a separate process here. It runs continuously alongside customer activities, right? So you get the data lineage from step 1 to step 6. So we talked about the retail operational journey here. So the key takeaway, the most important insight from this slide is this: retail banking is not a collection of disconnected systems, right? It's a continuous automated pipeline, right? From onboarding to reporting, everything is event driven, real time and data centric. In the next slide, slide 9, we'll contrast this with corporate banking, right? Operational journey, where workflows are longer, more customized and more risk intensive. So let's move to slide 9. So slide 9 is mapping the corporate operational journey, right? Corporate banking operational journey, right? Here also we have 6 steps. So the focus is relationship management, customization, and risk control, right? So now let's map the corporate banking operational journey. So at first glance, this may look similar to the retail journey, right? But in reality, it's fundamentally different in pace, structure, and decision making, right? So corporate banking is not designed for speed, right? It's designed for control, customization, and risk management. So let's walk through the journey step by step. So first step you can see in the slide is relationship management, right? The corporate journey begins not with a mobile app, but with a relationship manager or a RM, you can say that, right? So relationship management system, often CRM, capture client details, organizational structures, mandates and signatories, historical interaction. So in corporate banking, the RM is the single point of accountability between the bank and the client, right? So technology supports the relationship, right? But the trust and judgment drive it, right? So that's the difference here, right? So here the trust and judgment is more important than technology, right? Moving on to step 2, we have account and limit setup, right? So before any transaction can occur, the bank must establish corporate account or credit limit, product entitlements, right? So this happens in core banking systems, right? Lending and limit management platforms, right? So limits are approved based on financial statements, risk ratings, collateral and guarantees. So this step can take days or week. It's not like within minutes. It can take days or weeks. So account and limit setup can take days or weeks in corporate banking compared to few minutes in retail banking. Now come to the step 3, which is credit and trade finance. This includes letter of credit, right? So when you talk about letter of credit, so letter of credit is a bank issued document guaranteeing it a buyer's payment to a seller, right? Agreed upon, based on agreed upon shipping and documentation terms are met, right? So it is used heavily in international trade. So that is first thing that it includes in credit and trade finance. The second thing is bank guarantees. So bank guarantees is a legal binding instrument issued by a financial institution, right, promising to cover a debtor's financial obligation to a beneficiary if the debtor defaults on contract terms, right? So it's a risk mitigation tool for high value transaction, ensuring that if a party fails to perform, the bank pays, right? So this step also includes bank guarantees. Then there is structured loans. Structured loan is a customized complex financial solution for large businesses using a specific asset or future cash flow as collateral, often involving risk tranching, right? So tranching is basically slicing into different risk levels to meet unique funding needs beyond traditional loans, providing significant capital with tailored risk return profiles for lenders and borrowers, right? Then we have trade instruments, the instrument that we trade, right? So these products are like contract heavy, documentation intensive, closely monitored, right? So trade finance system manage documents, counterparties, payment conditions, risk exposure, every detail matters here. So that is step 3. Come to step 4, payments and liquidity. Corporate payments are high value, right? And often cross-border, right? Across multiple countries. And this is very time critical, right? Because the currency can come, go up, down, everything happens. Payments flows through treasury systems, swift messaging, liquidity management platforms. So these are the platforms you need to build if you are building a BFS solutions, right? For corporates. So bank must ensure sufficient balance, correct value dates, compliance with the sanctions and regulations. So errors here can disrupt entire supply chains. Step 5 is risk and compliance. So risk management runs continuously throughout the corporate journey, right? System tracks credit exposure, country and counterparty risk, right? So when you talk about country and counterparty risk, it represents the likelihood of a loss due to a party failing to meet obligation, right? That is counterparty risk, either from geopolitical economic issue in their home country or direct default. So the country risk is like geopolitical or economic issues in their home country, that is called country risk. And if there is a direct default, that is called counterparty risk. So the system should track it continuously, right? And the market movement as well, right? So market movement is market going up and down, right? Then we have regulatory compliance, right? So these systems should check regulatory compliance, right? So when you talk about regulatory compliance, so it is an organization adherence to the relevant laws, regulation, industry standard, and ethical practice, right? So ensuring operations are legal and responsible, right? And the transactions are screened for AML and sanctions, right? Anti-money laundering and sanctions. And also we check for breach of limits, unusual patterns, right? In corporate banking, risk is never an afterthought. Okay, let's coming to step 6. Step 6 is reporting and data management, right? Finally, all corporate activity flows into data warehouse, right? Regulatory reporting platforms or management dashboards, right? These data supports regulatory filings, capital adequacy calculations, and executive decision making. So accuracy here is critical. Small errors can translate into large regulatory consequences. So when we compare the corporate operation journey with the retail banking, the difference is clearly retail banking prioritizes speed and automation, corporate banking prioritizes control and precision. So retail decisions are algorithmic, right? Corporate decisions are more human-led and risk-driven, right? Now that we have seen both journey, the next slide will introduce the key participants who make all of this work, right? From customer and relationship manager to operations, IT, and regulators, right? So let's move to slide 10. So in slide 10, we are talking about the key participants in the value chain, right? Banking value chain, actually. So up to now, we have focused on system, journey, and architecture. But banks don't run on technology alone. They run on people, roles, and clear accountability. So these slides introduce the key participants who collectively make the banking value chain work. So each role exists for a region, right? Each role controls risk, cost, and trust in the different way. So let's look at them one by one. So the first is customer. So customer is the reason the bank exists, right? At the center of everything is customer. So this could be an individual retail customer or a corporate or institutional client. So the customer initiate transaction, hold account, borrow and invest money. So from a system point of view, the customer is represented by customer ID, profiles, risk rating or KYC status. So every banking journey starts and ends with customer data. So that is the first thing. Second is relationship manager, the human interface. In corporate banking specifically, the relationship manager or RM plays a critical role, right? So the RM acts as a primary contact for the client, understand the client's business and risk profile, and create structured deals and credit proposals, right? So the RM doesn't approve risk, but they originate and sponsor it, right? So the strong RMs drive revenues, right? Weak controls around RM create risk, right? And the third is operation team. So that is the execution engine. The operation team ensure that what is promised actually happens, right? So they execute and reconcile transactions. So they are responsible for processing transactions, handling settlements, reconciling accounts, managing managing exceptions, and then operation teams sit largely in the back office, right? We talked about front, back, mid office, right? And depend heavily on workflow systems. So, and operation teams are measured on accuracy and timeliness, right? If operations fails, even the best front office deal collapses. Now coming to number 4, which is Treasury Department. So the bank's balance sheet manager. The Treasury Department manages the bank's own money, right? So their responsibility includes liquidity management, funding and cash positioning, interest rate and FX exposure, right? So treasury ensures the bank has enough cash, meet regulatory liquidity ratios, and can fund lending and payments. So think of treasury as the financial control tower of the bank. Then number 5 is IT and data teams, that the individual backbone. So modern banks are technology companies with banking licenses, right? So understand it like that. So modern banks are technology company with banking licenses. So IT and data teams build and maintain core systems, integrate platform using APIs, manage data pipelines and warehouse, ensure security, resilience and scalability. They don't just support the business, they enable and constrain what the bank can do, right? So bad architecture slows growth, good architecture becomes a competitive advantage, right? And the last but not the least is regulators, the external authority. So finally we have regulators. So regulators set rules for capital, liquidity and risk, enforce anti-money laundering, KYC, reporting standards, audit bank regularly, right? So bank don't design system just for customers. They design them to satisfy regulators. So in many ways, regulators are the most important stakeholder in banking technology, right? Because bank don't design system for customer. They design them to satisfy regulators. So if you satisfy a regulator, it automatically satisfies customers, right? So the key insight from this page is the banking is a shared responsibility model, right? No single role owns the full process. So control exists because risk is distributed across people and systems, right? If you work in a banking technology, analytics or consulting, you must know who owns the decision, who owns the risk, who owns the data, right? In the next slide, we'll connect all of this to data, right? And introduce the core entities that power every banking system. So let's move to slide 11. So this slide is the data link, the core entities and attributes, right? So far we have talked about banking in terms of function, journey, roles and systems. Now we arrive at the most critical layer of all, data. So every banking operation without exception is built on a small set of foundational data entities, right, that we understand. No matter how complex a bank becomes, everything eventually links back to 4 core entities, right? So let's understand them clearly. So first is customer, who the bank is dealing with, right? The first and most important entity is customer. The customer entity represents an individual or organization, right? Their identity and demographic details, or their risk profile or compliance status. So the typical customer attributes include customer ID, name, type, KYC, anti-money laundering status, risk rating, KYC status, right? From a data perspective, the customer is the anchor entity. Everything else in the bank connects to the customer in some way, right? The second, which is important one, is account, where the money lives, right? So the second core entity is account. The account represents ownership of funds, right? Balances, limits, product relationships, right? So the common account includes account ID or the customer ID it linked to, or product type which is owning, right? And the balance and status, right? You can see in the slide. Accounts are usually maintained in core banking systems, so act as a system record of money, SOR, right? So third one is product. So product is the third entity, right? So product define the rules of the account or loan, like pricing, interest rate, fees, eligibility, behavior, right? Product attribute typically includes product ID, category, interest rate, fee structures, right? So these are the most important ones, right? So the product allows banks to standardize behavior at a scale, right? So rather than coding logic per customer, bank apply product rule across millions of accounts. So in retail banking specifically, this is most important. Now come to the fourth most important one is the transaction. What actually happens, right? So the fourth entity is transaction. So transaction captures movement of money, right? For the example, the transaction, timing and channels, right? How the money is moving, right? When the money is moving, right? Status and outcome, what happened to the money, and right? And what is the current status? It is failed or successful, right? Transaction attributes include transaction ID, amount, date and time, channel, and status, right? So transactions are the event that drive balances, risk calculation, reporting, and analytics, right? So these entities connect through let's talk about how these entities connect. So what's critical is how these 4 entities are linked. So a customer owns one or more accounts, An account is governed by a product. An account generates many transactions, right? So these relationship forms the data backbone of banking. You can see in this diagram, right? So why this model matters, right? Modern banks no longer think in terms of isolated system. So instead these entities are modeled in customer 360 platforms or enterprise data warehouses, risk and compliance systems, analytics and reporting layers. If these entities are inconsistent or duplicated, risk calculation fail, reports become unreliable, regulators lose trust. So the key insight from this slide is you can change channels, you can modernize system, you can redesign journeys, but these four entities never change, right? So if you understand customer, account, product and transaction, you understand the language of banking data, right? So in the next slide, we'll follow these entities and how they move through the system and visualize the end-to-end data flow architecture. So let's move to slide 12. Okay, so here we'll visualize the data flow architecture. So the target of this slide is visualizing the data flow architecture from customer action to regulatory report. So now let's visually trace how data flows inside a bank, right? From the moment a customer takes an action, right, all the way to regulatory reporting, right? So this slide shows the four logical stages of banking data flow: input, processing, control and output, right? So let's move across them step by step. So input, let's first talk about input. Input is customer and digital channels, right? So everything started at input layer. So this is where the customer interacts with the bank through the mobile banking, internet banking, branch or onboarding portals. So at this point, the bank captures identity data, account request, transaction instructions. The key thing here to note is the touch point, customer identity data, right? So the key thing to note here is the customer identity data, right? So this is raw front office data, the fast, real-time and experience driven, right? The second thing is processing. Processing is core banking and treasury system, right? So next data moves in the processing layer. So this includes core banking system, trade, finance, platform or treasury systems. So this is where the bank create account, post transaction, update balances, manage liquidity. The critical touch point here is account creation, right? Right, you can see in the image, right? So the processing system are transaction heavy, ACID compliant and designed to never lose money, right? So this is the system of record layer, SOR. So the third one is control, right? So once transactions are processed, they immediately pass through the control system, right? So this includes AML engines, anti-money laundering engines, risk engines, compliance and sanctions screening. The key touch point here is the transaction validation, right? So the most important thing is transaction validation, right? At this stage, the bank asks, is the transaction legitimate? Is it within risk limits? Does it violate any regulatory rule? Importantly, control system operate in real time in parallel with processing. So they exist to protect the bank and the financial system. So you understand what is control system now. The final thing is output. Output is data warehousing and reporting. So finally, validated data flows into the output layer. So this includes enterprise data warehouses, BI dashboard, regulatory reporting platforms. So the key touch point here is aggregated matrices. So this layer answers question that what is our exposure, right? What is the bank exposure? Are we compliant with the regulators? What do regulators need to see, right? Are we able to produce that when they ask us, right? So unlike processing system, this layer is more analytical, historical, and optimized for queries, not transactions, right? And optimized for analytical queries, not transactions. So why this flow matters? Let's talk about that. So most important insight from the slide is this. A bank never jumps straight from customer action to reporting. The data always pass through processing, control, validation, and aggregation. This is what makes banking auditable, regulated, and trustworthy. So the final takeaway from this slide that every number in regulatory report can be tracked back to customer, account, transaction, or system event. If you understand this flow, you understand banking architecture at professional level. In the next slide, we'll talk about real-world case studies of how a global bank implemented this architecture at scale, right? So let's move to slide 13. Okay, So in this slide, we'll talk about case study, right? So how the banks has created unified architecture at a scale. So up to now, everything we have discussed is value chain, journey, data flow, may sound conceptual, right? In this slide, prove one thing very clearly. This is not theory. These architecture are already running inside the largest global bank. So let's talk about two real world examples. So first case study, JPMorgan Chase, a US bank. So on the left, we have JPMorgan Chase, one of the largest bank in the world. So JPMorgan Chase operate across retail banking, corporate banking, investment banking, payments and treasury services. Historically, each of these businesses evolved with separate systems. The challenge was clear. Customer data was fragmented, risk was assessed in silos, and compliance monitoring was slow. And what did JPMorgan Chase did? The solution was a customer master system linking 200 plus applications across retail and corporate, right? So use a single unified customer ID. Every system, retail, corporate, risk, payments, now reference the same customer identity, right? So the result is the impact is transformational, right? So the real-time risk visibility across businesses. So you will have the same customer ID coming from for example, a credit card application or maybe a saving account application, right? So this customer master system can act as a central hub and links 200 plus applications, right? So this is stronger control over exposures, right? So your exposure will be aggregated, right? Otherwise, if you cannot link customers, it cannot be aggregated. The key insight here is you cannot manage risk at scale without mastering customer data, right? Then we have second case study of a EU bank, ING Group. So it operates across 10 plus countries in Europe. So ING faced a different but equally complex challenge, right? So they had multiple country specific core banking systems. So inconsistent data models, right? Heavy regulatory pressure under IFRS, right? IFRS is International Financial Reporting Standards. It's a set of global accounting standard developed by IASB, International Accounting Standard Board, to ensure consistency, transparency, and comparability in financial statement across jurisdiction, including the EU, right? And then there is AML. So the solution they have implemented is a unified core banking and data platform. So this platform standardized products and accounts, centralized customer and transaction data, enable country level flexibility on top of shared core system. So the result is phenomenal, right? So the outcome was strategic but not technical, not just technical, right? So the shift from product centric to customer centric banking, right? And the centralized data warehouse for IFRS and AML reporting, right? So the faster rollout of new products across countries, because this is more simpler now. This architecture allows ING to scale consistently, comply efficiently, and innovate faster. So what these case study prove? So both examples reinforce one powerful message. So modern banks do not win by adding more system. They win by unifying architecture and data, right? At a scale. So at a scale, the customer identity becomes the backbone, right? Data platforms become strategic assets and architecture decisions become business decisions, right? So the key takeaway from this is if you aspire to work as a banking architect or data leader or consultant or senior technologist, you must think beyond individual systems and design for enterprise-wide coherence, right? So in the next slide, we'll recap everything we have learned in chapter 1 and prepare for a deep dive into core banking systems. So let's move to slide 14. So in this slide, we'll do a recap from engine to data, right? So we have reached the end of chapter 1 and this is the moment to step back and connect all the pieces. So this chapter took us on a journey from understanding why bank exists to seeing how they operate and finally how data empowers everything. So let's recap the key insights. So the first thing that we discussed was retail versus corporate, right? So retail is high volume and standardized and highly standardized and automation driven, right? Corporate banking is high value, high customized, relationship and risk driven. These are distinct engines ensuring requiring different systems, processes and controls. The second thing we discuss is unified purpose, right? Economic functions. Despite these differences, both retail and corporate banking serves the same core economic purpose. They exist to intermediate between savers and borrowers, enable payments and liquidity, manage and distribute risk. But they have different execution, but the same economic foundation. We discussed about the value chain front to back. Next we learned that every banking operation follows a value chain. Front office initiate, excuse me, middle office control risk, back office settle and report. The structure is non-negotiable in regulated financial institutions. And we talked about data as a core. So finally we arrived at the most important insight of all. Data is the core of modern banking. So real-time integration of customer account, product and transaction enables operational efficiency, risk control, regulatory compliance. So bank don't just process money anymore, they process data about money. So what this means for you. So if you work in a banking, technology, analytics or consulting, system matters, architecture matters, data model matters. Understanding these foundations is what separates order takers from designers, coders from architects, operators from leaders, right? So our closing thought is chapter 1 was not about tools or platforms. It was about how to think like a bank, right? So in the next module, we will go deeper into the core banking systems, the system that sit at the heart of everything we just learned, right? So let's move. We'll talk about that. And in the next slide, we have some knowledge check and we talk about that. So let's move to slide 15. So we are in slide 15 where we have some knowledge check question. So now we have completed chapter 1, Introduction to Banking and Financial Services. Before we move forward, it's important to pause and reflect, right? Knowledge check is not an exam. It's a self-assessment, like way for you to test whether the concept is truly clicked. So let's walk through each question and understand why it matters. The question 1 is retail versus corporate banking. The first question asks you to define the difference between retail and corporate banking in your own words. So this is important because it tests whether you understand volume versus value, automation versus relationship driven models, why different system and control exist. If you can explain this simply, you have grasped a core banking truth. The second question is core banking data entities. So next you have asked to name 3 key entities shared across retail and corporate banking, right? So this checks whether you understand that banking system change, channels change, but core data entities do not, right? Customer, account, product and transaction are the language of banking data. Next question is customer information file or CIF, right? What is the purpose? So it tests whether you understand why banks need a single customer view, right? How CIF support risk, compliance and reporting, why fragmented customer data is dangerous, right? This is a foundational data governance concept, right? Now question 4. Simply ask why a unified customer ID is critical for compliance, right? And this connects directly to AML monitoring, risk segregation, regulatory reporting. If a bank cannot see all activity under one customer entity, it cannot manage risk, and regulator will not accept that, right? Right. So that's important. Question 5 is end-to-end data flow. The final question asks you to sketch a simple data flow from account opening to reporting. So this is the ultimate test. Do you understand front office, middle office, back office? Do you see how data moves across system? Can you connect customer actions to regulatory outputs? If you can draw this flow, you understand banking architecture. So the final thought is, if you struggle with any question, that's okay. Go back to the relevant side, rewatch this section, let the concept settle. This chapter builds the mental framework you will use throughout the rest of the program, right? So you are now ready to move from understanding banking to understand how banks are built, right? So thank you very much for staying with me in this video. Have a great day. Thank you.